Hey, it's Andrew Malcolm here, Mortgage HQ, and today we've got Dean from Kernel Wealth. I've met him recently. Joined a marketing mastermind with a bunch of other finance guys, and it's a lot more fun than it sounds. So Dean's going to tell us a little bit about Kernel Wealth and share, how he is seeing the market at the moment.
Hi, Andrew. Yeah, thanks everybody. It's been a pretty crazy, 2 years really. And maybe we're starting to get back to some sort of normality, or in fact, if anything, we're getting back to a period of time which most of us wouldn't have experienced before. That's been sort of one of the talking points over the last sort of 3 months is rising inflation. We're starting to see interest rates rise. And obviously you'll be very familiar of, the role of interest rates with your sort of day-to-day work and how things have changed on the back of rising interest rates, which in fairness, we haven't really had for 40 odd years. So it's definitely a bit of a change in the scenes, and people need to start thinking about, well, what does that mean going forward?
Yeah, I mean, the moral of the story is pretty much everything was cash flow positive a couple of months ago, and now that's not really a reality. So unless the rents are going to go up sometime soon, the type of investing is changing, and I guess that's one of the reasons why I am so interested in your space is because people are going to be trying to figure out where should they put their money, where should they invest their home equity, where should they invest their spare cash, and if they don't go on the property side of things, then what?
Yeah, exactly. And so for context, people aren't familiar, like we run a range of index funds. All of the index funds that we run are equity-based, investing in shares, so international, domestic, theme-based, like disruptive technology, electric vehicles, or more traditional sort of real assets, so infrastructure and commercial property type space. So we don't have anything in the fixed income. I guess broadly it comes back to nothing really changes from those good long-term time-tested approaches to investing. As always, everybody will talk about diversification is key. And that means you can have a mix of things. So investment properties, liquid assets like, index share funds, term deposits. It really comes down to finding the right combination for you and not trying to be, too complicated with it, and don't jump on the latest fad and trend. And there's no get rich quick scheme. I think sticking to the good long-term time-tested approaches will see you through. And the biggest thing comes down to the biggest question that people still need to continue to ask themselves is, when do they need the money? And that really is the starting point for any investment decision, as to when do you need that money? And that really then enables you to go and work out, well, what are the options that I have available to me then? And what's best suited to my needs? The biggest thing we've seen, obviously, is, I guess globally in the world, there's a lot of cash. There's a lot of cash, and that has to have found a home. And so term deposits and on-call banking accounts, you can't generate a sufficient return from those assets anymore. So if you were looking to prepare for retirement, or you're going to chuck it all in term deposit to generate a passive income, it just hasn't been possible over the last few years. And the scale of the amount of cash you need to sit in a bank to generate a standard passive income is phenomenal. Like to generate, when I looked at it about 6 months ago, to generate the average, or maybe it was the average salary in New Zealand, average income in New Zealand, you would need over $7 million sitting in the bank.
Yeah,
so you can't just go and generate a passive income. So that's why people have looked at things like shares, index funds, property, and why those assets have gone up. Now, as rates start to rise again, that will put pressure on certain assets. In particular, the sort of safe havens that people knew, like bonds, won't actually always be a safe haven. I think people sort of jump too quickly to the conclusion, oh, if I've got some bonds or conservative portfolios, then I'll do okay. We've got New Zealand bond funds out there that have got a negative 10% return for the last 12 months. Whereas, for example, there's global equity funds that are up 30%. Because obviously, as interest rates rise, the value of those bonds that you've got in your current portfolio are going to fall. And so rising interest rates pose some challenges for investors. I think it comes back to, if anything, that sort of means, well, if you've got time on your side, most will still continue to look at a relatively high growth portfolio. But again, keep it well diversified and keep it vanilla. That's with some of the interesting behavior we've seen over the last sort of 12 to 24 months has been, obviously, it's a global trend, rise of sort of, I would argue, quite speculative day trading type behavior, or meme stock trading. I think we're starting to see the end of that, or that's come to a bit of a cooling off period. But there's some really interesting data out there on that, and it is concerning and to some degrees, but equally it's positive that people have become engaged with different types of investing and what is available in the world.
Yeah, you were talking the other day about the top 10 traded funds, or what tell us about that. That caught my attention.
So funny enough, I was looking at it again. So there's obviously been a global rise of sort of easy access trading platforms that make it, from $1, any investor can start trading, US shares. A lot of those platforms are powered by a broker called DriveWealth out of the US. And you can actually go to their website and download a quarterly investor report. And it's a great little research paper. They put it out once a quarter that kind of shows the trends from all of the different platforms using their APIs. The top 10 traded stock globally on DriveWealth through all of their platforms globally, their partner platforms globally, by volume is AMC. So AMC Entertainment. This was a stock that popped onto everybody's radar earlier in the year. I can't remember what it was. Maybe it was $8, $9, and it shot up significantly, $60, $100, whatever it was. With the idea, I think Reddit-based investors felt that there was a opportunity to create what's called a short squeeze, put some pressure on hedge funds, and resulted in a range of new terms like hodling and meme stock trading and a mother of all short squeezes, and all these sort of things came on the back of it, where people felt this thing was going to go into the thousands of dollars, and it was the get rich quick. Price shot up, but it's been a pretty hard 6 months for those investors, particularly if you jumped on late and started to follow the herd mentality. I was looking at it literally this morning, and it is down 52% for the last 6 months. Now, that's probably going to go down negative 90% if it falls back to where it was the pre-speculative sort of trend.
Yeah.
So there's a lot of this sort of behavior where some people will win and get significant wins. Now, if they were holding that stock just before it went crazy and they sold out at the top before everybody else started piling them, there'll be the one or two people out there that fuel it by the stories of I've made 10x on an investment. But reality is, for 99% of people, they're probably too late to the party, not able to time it, and will actually get severely burnt. And we've seen that generally with some of that data. So I think that's where we're seeing a slow decline over the last couple of quarters of that sort of retail, sort of real speculative trading mentality, as people look back to, I guess, some more traditional longer term approaches to investing. And again, I come back to, I think a lot of people who may be relatively new to investing in equities probably have overly inflated expectations of the sort of returns that you can get,
and the time frame.
Yeah, exactly. Anybody who started investing in housing or shares in April 2020, you could have gone and made 30, 50, 100%.
Yeah.
But that's not normal, and you won't get that every single year. You've got to look back to the longer term picture here and get a bit more realistic about what is good long-term investing.
Yeah. So DriveWealth, there was some other bigger names in there, right? Tesla and
Tesla, GameStop, Neo, all the sort of big popular meme
clickbait names, yeah,
clickbait names that everybody's chatting about. And it's just a reminder, there is no get rich quick scheme. And in fact, that's sort of an area that you want to be very cautious with. And like anything, and if you're interested in it and you have a bit of FOMO, put a couple of % of your wealth in it. Don't go invest your entire portfolio, your entire life savings on one thing. It's just never a wise idea.
Yeah, I mean, if you take that most people don't have $100,000 to invest in, a side investment portion, it's like not that much to spread around, and the indexes is probably the safer thing to do because you're far less likely to try to day trade it. If you're day trading, then the chance of losing, because you're competing against the world's smartest people who they prey on the normal everyday investor that does it like on their lunch break, that you are the prey.
Exactly. Like financial services become exceptionally complicated and professionalized, and even the professionals don't outperform the market. And that's just, I guess we come back to, we're a data driven business. And when the stats show that even the professionals who have, who are trading in microseconds, who have PhD candidates and quant analysts and CFA holders and the most up-to-date complex trading systems, when most of them running active funds show that 90-95% will underperform an index over 10 years. It's exceptionally hard. And I guess that just comes back to actually the most logical way to build long-term wealth, which even Warren Buffett and others talk about, is just index funds and keeping it simple, not overcomplicating, and keeping your costs down. And it's unfortunately not the sexy way about going and building wealth, but it's probably the thing that will get you there.
Yeah, I think building wealth is like a distracting term because it makes it seem like that it's gold mining, that you're trying to search for something, whereas it's more like protecting and harvesting, like farming your wealth. You put 100 grand in an account and you get 7-8% a year for 20 years, and it's you should focus, instead of on managing it day to day, just adding to the account. So if you spend the time and stress that you would on day trading or week trading or month trading, if you spend that energy on building a small business or a side hustle, or that's probably going to make the bigger difference.
And that's the thing, right? It's just balancing up all those pieces. So we see a lot of people who come to us who've got investment properties or who may have a combination of things, and they're just trying to find the balance about how do they put these pieces together so that they can maximize it over time, and how they're managing their cash flows. Like, should they be putting disposable cash flow into paying off the mortgage, or should they be investing it? What's going to maximize their wealth building over time? And you're just trying to find that balance that's suitable.
Just increasing contributions is going to be and that's hard for some people to hear, especially if they're only really just kind of making ends meet. You got to try figure out how to, instead of contributing 3 or 4%, try and contribute 5 or 6%. It's
this thing, like everything. I always come back to the sort of New Year's gym analogy. Just be realistic. You can start small and build it over time. If you all go out there and say on New Year's in a couple of weeks' time that I'm going to go to the gym 6 days a week, you're not going to keep that up. You're going to burn out pretty quickly. But if you start small and build into it and increase it over time, you don't, like exercise, like paying off the mortgage, takes time, but then all of a sudden it really starts to compound. Now, those first few years of like paying off your mortgage, you feel like you're making hardly any progress, right? You're paying so much in interest, but then all of a sudden it really starts to chip away quite quickly. It's the exact same with general investments. The first few years, those contributions going in, you'll see the returns on them slowly build up, but then 3, 5, 10 years down the line, that compounding really starts to accelerate.
Yeah, I mean, you make 8% on 100 grand. A year later, of all the stress that you thought about, it's only 8 grand. It's not and then you put it's just
exactly. But being patient and sticking with it is the key, and that's the big differentiator. I think people that build success and wealth over time is making that concerted effort and sticking to it, and not panicking and not getting drawn into sort of the speculative chasing quick wins, because you just get distracted and you won't be doing the things that really are working for you.
So in terms of like picking funds, not all index funds are created equal. And especially at the moment, there's a lot of nuance, let's just say that. So what should people be looking for in terms of picking an index fund?
There is, like with everything, there's a broad spectrum, there's a range of choices out there, and how do you find what's right? The regulator here, the Financial Markets Authority, they put a lot of emphasis on fees. Now, fees do matter, but fees are only one part of the cost of investing. So with a fund, you'll see a management fee. So that could be 0.25% or up to 1.5%. Obviously, the lower the fee, the better. Unlike a lot of things, actually, the more you're paying fees, that's just taking away from your returns. Low fees matter, but so do the hidden costs of investing. So are you paying brokerage fees? What's the tax structure? So if you're a higher rate investor, then you do want to be looking at, so if you're on a 33 or 39, or you're investing via trust and you've got higher tax rates, then you do want to be considerate of the tax structure of the product you're investing into. With Kernel, those hidden things are something we really wanted to solve from the very first day when we set things up. There are some simple ways of doing things, but the key for us was, well, how do we solve to make these the most tax efficient products, most overall cost effective for investors? Whether you care about it or notice it on a bit of paper doesn't really matter. We know over time will be better for investors because the way we're set up from a tax point of view is probably the most efficient for the majority of investors in New Zealand. It means you just simply select your tax rate and it will calculate at the right PIR rate. Now, start with that, figure that out, look at the fees. The main thing, I guess, where a couple of options for investors is you can go and find a single fund that's already diversified and got a combination of things in it, so international equities, domestic equities, etc. Or you could pick a handful of funds for yourself to mix together to how you choose. So you may go, say, if an investor came to Kernel, they could go, I like your global 100, I'm going to have your New Zealand top 50, I may add in a bit of infrastructure, and I'm just going to mix them in a weighting that suits. I think the key thing where we probably see investors make a poor decision is they overcomplicate it. So some platforms you have hundreds of investment options to choose from, and they'll go on there and go and pick 20 or 30 funds. You don't need to do that.
But like $500 in each.
Yeah, exactly. And you're just randomly picking it, and that's just adding to cost and maintenance, and you've got unintended consequences of that. Picking 2 or 3 funds, as long as you end up with some broad exposure to some international, some domestic, as well as different sectors, so you're not reliant on one thing performing well, then you're pretty well set up. So you can do that by picking 2, 3, 4 funds yourself, or simply going and picking a single fund that's actually done that for you, keeping it really simple.
Yeah, I mean, people pick multiple index funds for diversity, but they forget that it is an index fund.
It's already diversified, and the biggest consequence of that sometimes is they become overly concentrated in something they didn't intend to, because they've got things that overlap or vice versa. And
and you start actively managing your index fund allocations. People can't help themselves. Probably the best thing to do is to log out every 3 months. Only look at it very intermittently.
Oh, that's the best practices once you set it up, and it's actually, there are good and bad things to that, right? We want everything 24/7 real time in our pocket. The best behavior is actually to not look at it, not change it unless your circumstances change. Don't react to the headlines, because we've seen that, the last 2 years is a great case in point where if you were reacting to headlines, and we saw that in the Kiwisaver space last year, right? People panicked and sold out and went from growth to conservative, and then missed the massive rebound. If your circumstances hadn't changed, there was no reason to change your strategy. You don't need to be responding day in, day out and panicking based on headlines or what your mate told you. Set it up. It's well suited to what your long-term goals are, and forget about it. We can't time the market. We can't respond to. We don't know what the future is going to hold.
So, what do you think's the most interesting thing happening in the investment space in New Zealand at the moment?
Well, there's a couple of really interesting things happening at the moment and over the next year, and probably a lot of that centers on Kiwisaver and also sustainability. So that's kind of the big new trend that's coming through. So a couple of weeks ago, there were changes to default Kiwisaver providers. So the default Kiwisaver providers is basically a list of Kiwisaver providers who, if you don't select Kiwisaver Manager where you're first allocated to, you'll be given to a default. Majority that was held by the big banks. A number of them lost that status in December, and that's just been transitioned over. So there was a few 100,000, I think 230,000 investors in default Kiwisaver schemes who were moved between providers on the 1st of December. So anybody that is listening that hasn't checked who the Kiwisaver is with, that's number one thing to go and do. But interestingly, when that change occurred, they've changed the investment strategy. So it's moved from being a conservative strategy into being a balanced strategy, so a higher allocation to equities, which broadly speaking is probably going to be good for investors over the long term. Probably more interestingly though, the government introduced some regulations that actually banned the holding of oil and gas assets.
Crazy,
both domestic and internationally. So no matter, I guess it's an interesting one, no matter where you sit on the political spectrum around government regulated intervention into the types of assets you'll be investing into. We're also about to see next year on the back of that, I guess, we are seeing a fundamental shift within the investing space towards sort of sustainable and ESG type investment strategies. There's a thing called TCFD, Task Force for Climate Related Financial Disclosures. This is a global initiative. Basically what it is it's a framework for companies and financial services providers to be thinking about climate change and the role of climate change within their business. It's been voluntary. It's a voluntary initiative. And it basically sets up for the governance, so the board of directors, management, to be thinking about climate change, setting up some risk management tools, reporting. New Zealand has become the first country in the world to mandate this. So with the current draft legislation, what does that mean? Well, end of next year, every listed New Zealand company, so every company listed on New Zealand Stock Exchange, every bank, every non-bank deposit taker, every insurance provider, and every fund manager with over $1 billion will be required by law to operate under a TCFD framework. So from a fund manager, including Kiwisaver, that means as a fund manager, you will actually have to do this at a per fund level. So every fund you're operating, you have to consider the climate-related risks of the assets within that fund, set up a governance or reporting framework, how you're going to measure the climate-related risk, how you're going to forecast the climate-related risks. There's a lot to flow under the bridge still with this, but it's, again, something that really isn't talked about in the media at all, but this is quite a fundamental piece of legislation that's coming through. And to be the first country in the world to mandate this is a big bar in terms of the amount of reporting that's required, the information that's required. Yes, there's a lot of work that I think people, even institutions are going to have to think about.
Same things happened in the advisor space for mortgages and insurance. The regulations have become a lot stricter, and the premise behind it is fine. You want to look after clients. There's no issue. It's just going to add a lot of compliance cost, and usually that gets passed on to the end user. And I'm sure it's the same with Kiwisaver funds, and everyone affected, they still want to make the same amount of money, so they've got to pass that cost on.
Yeah, and so there's a real tension, right? Because you've got the regulator trying to say, particularly within the investing and funds management space, we want to see fees lower, but on the counter of that, there's an increasing ratchet up in terms of the amount of compliance and reporting that has to go on, and that does come at a cost. And particularly when you're going into new areas like TCFD, where you're having to, for the first time, figure out how are we going to report on this? How are we going to get the data? How many people does it take to process this? There is no systems or structure. You have to establish it from the ground up. So it's not going to be the most efficient from day one. And that's going to take time.
Yeah, my experience with regulatory changes, even though the documentation explanation might be quite long, there's still a lot of ambiguity of like how actually this is going to happen.
Well, the really interesting thing, exactly. I think the interesting thing on the TCFD, I think you're going to be halfway through the financial year before you even know what the reporting standards are that you're going to need to report on. So it's all going to happen pretty quickly. The bigger thing then is, well, on the back of all this, you do all this reporting, and then what? Well, actually nothing. You put this report out there, it sits on a shelf somewhere, it doesn't actually trigger anything straight off the bat, but undoubtedly over time, we will see change on the back of it. They'll be either saying, oh, you need to improve your TCFD standards by 10% or something along that lines over time.
Yeah. But it'll get indexed and crawled by all the bots, and things will get found.
But sustainable investing is definitely, I guess, a big theme of what we'll see in 2022. And people are looking at that from not just a values point of view. People are investing in sustainable and ESG type products, not just because it aligns with their values and because ultimately we all do care about, creating a positive change in the world. But increasingly people are investing it because they think actually the performance will be better. And there was a global survey of 23,000 investors, and 42% of them, I think it was, or 47%, said they were investing in sustainable funds because they expected high returns. And so this traditional thinking from 5-10 years ago that sustainable investing and not investing in certain sectors, etc., would impact or harm your performance has kind of been debunked. And now, if anything, people are looking at companies that score well from a sustainable lens will do better going forward. And that's partly because we're operating in a world where consumer demand is changing rapidly, and the expectation is for sustainable and socially responsible products. And companies that aren't acting are probably going to face the hammer of the regulator in some form or another. Electric vehicles is probably a great case point. A lot of Europe is banning the sale of fossil fuel internal combustion engine cars from sort of 2030, 2035.
Yeah.
So there is a line in the sand where the regulator is going to tell companies, you're either selling electric vehicles or you're out. And so regulation is also going to force a big fundamental change going forward.
Yeah. And you get reversion to the mean on all these things, and the nuances difficult to understand. And when people often say they want to, when they're coming through for mortgages, they'll say, "Oh, look, I want to work with a Kiwi bank like TSB or Co-op or Kiwi Bank." And I say, "Hey, look, I understand, but if you get a better deal to the tune of say $3,000 from an Aussie bank, you can give that money to a sustainable charitable trust. You can, if it makes more financial sense to go in another direction, you can give the difference. It's the same, like if you want to invest in guns or ammunition or tobacco or anything that's not sustainable, it will eventually make more money because the price will get pushed down. As long as the regulatory stuff is looked after, there will be good companies in that space.
There is a broad spectrum of things, and when it comes to sustainable investing, I guess one term I'm always apprehensive is ethical, because ethics is very different, but everybody has different views to the degree around sustainability or impact or not that they want to have. A really interesting one to the exact case that you sort of gave the example of, one of the nun societies in America decided to take action in terms of gun violence issues by becoming a large shareholder in Winchester, so that they could particularly influence the board by voting and being actively engaged in that company to drive change. Because if we just don't invest in it, we have no control, we have no say, we're just choosing not to invest in it. But they decided to actually become a strategic and large investor so that they could get in there and disrupt the board and say to them, actually, this is the change we want to see made in this company around gun control issues.
Yeah, and the difficult thing for the nuns, I'm guessing, is the strategic thing would be to accumulate their position over a period of months or years and for nobody to know what they're doing. I suspect what they may have done is said, hey, we're going to take a big position so we can control it. And the price got pushed up against their wishes.
So there's a lot of nuances that come through. But I think, looking ahead, sustainable and just broadly like disruptive trends, we are in a period of unprecedented change, and we're seeing that happen at increasing pace around us. I think one thing that most people may not realize, but we're in the fourth industrial revolution. So the US is forecast, the US workforce is forecast to have 32% of employees change career and job sector by the end of the decade. That's 40 to 50 million people are going to have to change career in America within the next 8 to 9 years.
Yeah.
That is fundamental. Now, these things sound exceptionally scary, and you see these headlines out there about this disruptive change, but we've had it several times over, and actually a net result of these sort of revolutionary periods has been greater productivity, higher wages, greater employment. Society benefits from it. But the headlines sound scary, and you will see a lot of fear mongering around this and people going, oh God, I'm going to have to change my entire career. But you are seeing it happen, and it's happening pretty quickly. And just even things like the whole commercialization of space. Who really would have thought about this as a whole sector, and that would have private citizens flying into space and tourists landing in the International Space Station 5-10 years ago. These things have happened pretty quickly.
Yeah, I was just reading General Mattis's book on Call Sign Chaos. That's what the book's called. And he says like the two new realms of war are space and cyber. And I know, for American military, for example, they'll be spending a lot of money and effort on protecting themselves and that. And so most big countries around the world are going to be spending a lot of money on space and cyber, and that is hopefully going to fuel growth in those areas. And there's no doubt there'll be some depressionary times, but I think we all agree there's a long way to go in terms of technology improving our lives. A lot of people around the planet still don't have access to plenty of things that we take for granted.
And there's stuff that we have that we're starting to question, is it good for us or not? But
some of the foods that I see these guys in the office eat, I just
What is the role of social media?
Yeah. Well, I can say that quite a few of the lads that are gamers are excited about, the metaverse or whatever it's called. Like, good on them, right? It's probably something that hopefully I'll get to bypass. I'll just keep reading my books. So what are you following at the moment in terms of news and newsletters and blogs? Like, where do you get your ideas?
I'm a big news junkie. I do love the news. Just all sorts of news channels. That tends to be my normal daily routine in the morning, is sort of get up and sort of troll through the latest headlines and sort of try and keep across of it. And I think it's important in today's world to actually look at news from multiple different channels, because increasingly they are opinionistic, and I think that's where the danger has occurred, where too many people read one channel and get driven down a rabbit hole of thought processes. And it's important to look at things from all angles and really question it. And despite the challenge of it, Reddit is always interesting, if not just for the laughs, to see what the sort of the theories that are spinning out there. And again, if you can look at that without taking it necessarily, look at it with a grain of salt without taking it too seriously, it's always an interesting place to get a sense of what sort of thought processes and ideas are sort of bubbling away underneath in different parts of society.
It's you can spend a lot of time on those rabbit holes on the internet with some crazy conspiracy theorists, and some of them are real convincing.
And it happens with just news, and I think it's important we've got to be well educated and understand that we make sure we question everything and don't just take things as gospel. But you need to say that with great caution, because then people will say, "Oh, mainstream media, you can't take all that, etc." But
So, assuming that a lot of people have tried Sharesies or Hatch Invest, or they got Smart Shares account or whatever, like what's going to make people want to jump over to what you guys have got on offer at Kernel?
So I'd say we've probably got, one of the most cost and tax effective and broad range of index funds in the market. It's super accessible online, all different account structures. It is all designed for the long-term set and forget type strategies. And I guess that's where we see a few things happening. We do see people come to us and put the core of their investment portfolio, their regular paycheck, into Kernel. And if you want to have some fun on the side and you want to invest some direct shares or have some play money, great, go and open an account with a trading platform. But don't do that with your entire wealth. Set something up that is going to get you to those long-term goals, that's going to do its thing no matter what, and make that clear distinction. And that's what we tend to be seeing now. So we've got some pretty exciting things planned for the first quarter as well. So it's if anything, just keep an eye on what's happening. We've got some great content as well. So we do try and put out some good content for investors to read that really helps them understand what's going on in the markets, different ways to think about investing. So no matter where they are on the spectrum, if it's the first time or they're quite sophisticated, I think we've got something to offer.
I was just teasing Dean before we started this call that I was looking at his LinkedIn profile, which don't be afraid to do. You got the background in NZX and Smart Shares and the data side of things and establishing ETF funds. So it seems to me like what you're talking about in terms of getting funds started that are safe and it makes sense.
My background was a long time at Smart Shares when we were 5 funds, and there were a lot of learnings that how do we make those products more accessible and better designed, because I guess one of the things, it's easy to kind of open up the access and make things more accessible, but at the same time, not only do we want to do that, but we wanted to make the products that people are actually investing into better. And whether they see it or not, just around things like tax efficiency, we know that will be better for investors over the long term. There is a lot of hidden costs we've been able to scrap and make it better for customers, and that should mean over time better results.
Yeah, I mean, how much? What's the average amount of businesses, or no? I'm not sure if you do commodities or anything. What's the average number of different investments in each of the funds?
Yeah, so it varies. So our largest fund has, I think, 260 odd companies in it, and the smallest goes down to 8. So that's New Zealand commercial property. So there's a broad spectrum in there. Most investors would have 2 or 3 funds, or if they're not sure what they want to do, we actually have a high growth bundle that's made up of 6 funds, so you can just click on one go and get started with it.
Yeah.
And our average investor has really changed, quite a lot. We have people who are starting out for the first time. Our largest investor is over $10 million. So again, we've got people with all wealth spectrums using these as the core long-term wealth building blocks. And most people tend to be putting away sort of $1,200, $1,500 a month. It's one of those things where we've got a lot of people who are just regularly giving disposable income, cash flow from other assets, or leftover cash from their work that they want to just be maximizing and doing something with. And that tends to be a really common approach.
Yeah, and it sounds like a massive number, and it is for a lot of people. That would be a big number. Having said that, if you are thinking about investment property as your vehicle, and then you're feeling like now the market timing's not right, then you should be getting that sort of cash flow from your income or your properties that you can put it away, and you can at a high level make two decisions. You can offset or pay down debt, or you can keep investing in other things.
And we're seeing it. Like, we do have people who've got investment properties who may have a couple of investment properties and want to sell one, so they've got some more liquid cash that if they want to go and draw down 20 or 30 grand because they've got some medical stuff, or they want to do an upgrade on something, that they've got a combination. And I think increasingly we're getting people realize actually it's not just one or the other. How do these things work together, and how do I just try and maximize and make the most of my situation?
Cool. All right. Well, I guess people just jump on your website and figure it out. I had a look. It doesn't look like it's that difficult.
Yeah, no, exactly. And we are on LinkedIn, and we've got an 0800 number, so we are, we're human. We're here, but like your team, I guess it's about being able to chat to somebody as well if you need it.
Yeah. Now we got up around 40 people now. You're getting pretty close to that as well, right?
21. Still a wee way to go. But it's,
you were saying the other day you're expecting a lot more to join next year, right?
Exactly. Yeah.
It's fun times having people that are keen about money in the office talking about money.
Exactly. And and reality is, there is still a lot of money out in the world that's looking for a home, and that's sort of one of the things that's really boosted things over time. I think one of the most final, I guess, interesting stat. I think there's about $250 or $260 billion sitting in New Zealand on call bank accounts and term deposits.
Crazy.
That is a huge chunk of money that is sitting out there. That the reality is, for the vast majority of it, in real terms, after tax and after inflation, that is going backwards.
So, well, my nana's a classic. She's got like 60 grand term deposits or something. I mean, she needs the money there, but not really.
So it's that's a big chunk of money sitting out there that it doesn't take much of that to start moving around and things start changing.
All right, thanks, Dean. I appreciate it, man.
Thanks, Andrew.